Once market volatility settles down, India should emerge once again as an investment destination of choice. Now, as Ms. Bhattacharya said, in this environment, there is both challenge and opportunity. Challenge because the world will not provide the strong and supportive growth that we had in the past decade. Opportunity because global capital is looking for investment opportunities, and what better place than India today? As I said last year in my Bharatram lecture entitled Make in India, Largely for India, to implement the Prime Minister's vision of producing in India at a time when trade across the world is falling, we will have to strengthen the domestic market so as to absorb much of the increased production until such time as the global economy recovers. This means we have to increase domestic demand while avoiding the booms and busts that typically plague such efforts by emerging markets. My focus in today's talk will be on what the RBI is doing to help the government create the conditions for sustainable growth. Now, structural reforms will help strengthen this growth. 2 weeks ago, as many have said, the government announced Indradhanush. I should mention that the RBI has been working with the government all along the way, contrary to some newspaper reports. The fact that we weren't on the podium is just because these are government banks, and the government has a right to announce what it does with government banks, but that is not to say that we haven't been working with the government. Last week, we licensed new payment banks. Next month, we will license new small finance banks. In fact, this morning, as I was coming down Marine Drive, or Dr. Netaji Subhash Chandra Bose Marg, I saw a hoarding for Bandhan Bank, the first new bank for over 10 years. I think that was a wonderful sign to start today. In November, we will announce the providers of the TRED system who will be licensed at that point. There are lots of changes happening in the system. Indeed, this entire conference is focused on the timely issue of technology in banking, which is bringing about a revolution in how the industry accesses, transacts, and supports the customer. In fact, we're going to try and move more of customer redress also onto the electronic platforms. But given the times, given the state of the markets, I want to focus on macroeconomic issues because I think they're very important at such times to reassure the markets that we have the macroeconomic problems under control. And I want to leave the structural changes that are really the focus of this conference to a future speech. Let me start by saying we've come a long way since the difficulties in 2012-13, primarily as a result of actions taken by the government and regulators. However, 3 areas are still work in progress from our perspective. First, I agree with Dr. Jyotsna Suri in saying that economic growth is still below levels that the country is capable of. Second, while consumer price inflation has moderated, inflation expectations amongst the public are still high, creating a gap between the real rates that the savers in your banks expect and the rates that corporations think they pay. Third, stressed assets in the financial system continue to be high, which holds back growth and new lending, even while dampening bank incentives to cut base rates. So therefore, our short-term priorities, the short-term priorities of the Reserve Bank are very clear. We need to help by bringing down inflation in line with the proposed glide path, thus creating room for the monetary easing that Dr. Suri desires, and I think much of industry desires. And second, we have to work with the government and banks on speeding up the resolution of distressed projects and cleaning up bank balance sheets so banks are capable of lending in a big way again to the major projects that the country is embarking on. Let me start first with inflation. Now, of course, I'm sure that many of you, these cameras, don't want to hear me talk about the theory of inflation. They want me to say what I'm going to do next on policy. So for that, I think the best summary is still our last policy statement, from which I quote, and I quote, "Significant uncertainty will be resolved in the coming months, including the likely persistence of recent inflationary pressures, the full monsoon outturn, as well as possible Federal Reserve actions. As the Reserve Bank awaits greater transmission of its front-loaded past actions, it will monitor developments for emerging room for more accommodation." So I end quote there. I have said all I want to say on future policy, and please don't read anything in what follows about the future direction of policy. We will, of course, take all the information we've had so far, as well as the information we will get in determining that policy. But I want to explain what we've been doing and why we've been doing it, because ultimately, control of inflation has political overtones. It is something the public has to understand, has to be appreciative of for it to succeed. And that's why I want to make the case for why this is so important today, apart from the fact that low inflation is something that our foreign investors are extremely interested in. It is something that has been at the root of what the public in India also wants, and I want to make the case once again. Now, again and again, we enunciate this mantra that the poor are hardest hit by inflation. Yet, despite this known antipathy in India towards inflation, we've had more than 9% inflation on average between 2006 and 2013. 9% inflation for a country that purports to dislike inflation. The longer we had high inflation, the more the public's expectations of inflation became entrenched at high numbers. And because the public's expectations are adaptive, meaning they change only after they see a sustained change in realized inflation, we required a long period of low inflation before expectations came down. Unfortunately, our focus in the past on WPI inflation, which typically puts more weight on international traded goods like commodities rather than domestically non-traded goods like education and healthcare, domestically produced non-traded goods like education and healthcare. This meant that when international inflation came down, the clamor for rate cuts increased. So we often did not take the fight to domestic sources of inflation. Put in technical terms, the policy rate was below the neutral real rate for years, and that coincided with a strong pickup in CPI inflation. Things can change, and things are changing. The strong disinflation, even deflation in the world in the last few years, gives us a golden opportunity to do so. What better time than the current for an inflation-prone country like India to bring its inflation finally in line with the world's? With commodity prices declining and astute food management by the government, part of our work is done for us without India having to undergo the extreme demand compression that was seen, for example, in the United States during the Volcker disinflation. Indeed, today, with real expected policy interest rates in the 1.25 to 1.5% range, and approximately at the neutral range for perhaps the first time in a long while, and with real after-tax deposit interest rates barely positive, it would be hard to argue that the disinflationary glide path the RBI has embarked on is extremely onerous, with a few exceptions that I'll come to in a second. Now, while low inflation for a sustained period will lower the public's inflationary expectations and increase their real disposable income, in order to achieve a sustained victory against inflation, the public has to believe that inflation will stay low even after commodity prices start picking up in the future. And they will. Eventually, oil prices will pick up, though our estimate is at least for a year or two, it will stay at low levels. Now, for the public to look through these future price spikes without raising prices, without raising wage demands, the central bank, the Reserve Bank, has to have the credibility that it will act against any future inflationary threats. And this is where central banks in advanced countries have achieved that credibility, which is what allows them to stay with low interest rates for long. And credibility that they've achieved doesn't come from some God-given abilities, it comes from frameworks and institutions. And we are in the process of building those frameworks. The RBI signed a historic agreement with the government wherein the RBI's inflation mandate is clearly spelled out with an inflation objective over the medium term. In the coming year, the Finance Ministry proposes to lay out, after consultation with the RBI, the structure of a monetary policy committee that can be formally and legally entrusted with policy decisions. These are extremely welcome steps in building the institutions we need for transparent and independent monetary policy, and trust in low inflation will give investors the trust they need in the markets and will be something that will help us going forward for many years to come. Now, of course, many have expressed views, comments on these. Let me address some popular misconceptions very quickly. Modern economic theory suggests there is a short-run trade-off between inflation and growth. Layman's terms, if today the central bank cuts interest rates by 100 basis points and banks pass on this interest rate cut, demand could well pick up and we could get stronger growth for a while, especially if economic players are surprised. The stock market may even shoot up for a few days. But if the economy is supply constrained, we could quickly see shortages and a sharp rise in inflation. A central bank may then be forced to raise interest rates substantially to offset that temporary growth. The boom and bust will not be good for the economy, and average growth may be lower than if the cut had not taken place. This is why modern economics says there's no long-run trade-off between growth and inflation. There's a short-run trade-off, but no long-run trade-off. The best way for a central bank to ensure sustainable growth is to keep demand close to supply so that inflation is moderate and you don't have these rapid changes in policy which are disruptive as well as rapid change in activity. Put differently, when people say inflation is low, now turn to stimulating growth, and we get this advice all the time, they really don't understand these are two sides of the same coin. The RBI always sets the policy rate as low as it can, consistent with meeting its policy objective. Conversely, the best way that the monetary authority can support growth over the medium term is to keep inflation at low levels so that the policy rate can be low, much as the central banks in other countries have done. We can never abandon inflation to focus on growth, nor do we focus on inflation to the exclusion of growth. It's always looking at both these things. How do we take growth into account? We've set up an extended glide path over which we are bringing inflation in check. And this glide path, the duration of the glide path, appropriately balances growth with our inflation objective. The statement, inflation is low, you can now turn to stimulating growth, also perhaps reflects a misunderstanding of how central banking works. Monetary policy typically works with long lags, 3 or 4 quarters, as we've seen in India. So in deciding policy today, we need to predict how inflation will look approximately a year from now. So today's inflation matters only in informing us about future inflation. But there are so many things that complicate today's measurement of inflation. For example, if last year there was an unexpected price spurt around the same months, today's inflation will look unnaturally low because it's measured over a high base. This is called the base effect, and that does plague the most recent readings of inflation. We have to take out these base effects before we understand what truly the momentum of inflation is. But also, between today's inflation and next year's inflation, there are a number of economic uncertainties. For example, the strength and distribution of the monsoon, the extent and persistence of low commodity prices, the effect of external disturbances that we see on the exchange rate, and so on. So in practice, how do we estimate future inflation and then determine policy? We use a number of models which give us a sense of how these factors have played out in the past and how they may play out over the course of the year. And we overlay these models with our own subjective assessment informed by all the advice we get from both the public as well as technical advisors. Now, our projections of inflation are not perfect forecasts. Because of uncertainties in the economy, they are likely to be off a little bit. But they reflect the best assessment we have of what is going to happen, and we set monetary policy accordingly. For example, since the beginning of this year, because we saw persistent declines in inflation and because our models then suggested these would persist, we were able to cut interest rates 3 times. Going forward, we will again follow a similar approach to decide what to do. Now, what such an approach rules out, however, is a seat-of-the-pants approach which sometimes is very popular, what I call inflation following, that some populist commentators advocate. Now, typically, this kind of behavior starts with the idea that all economic forecasting, especially about the future, is impossibly imprecise. So these commentators advocate cutting policy rates whenever inflation is low until inflation starts picking up. So inflation is low today, let's cut rates.